Between January 2020 and December 2025, something extraordinary happened in the precious metals market. Gold doubled from $1,500 per ounce to over $4,000. Impressive. But silver exploded from $12 to over $50. That's a 316% gain compared to gold's 166%. And here's what most analysts are missing. This isn't the end of silver's run. This is the setup for the real breakout. For the past 5 years, every financial expert has told you the same story. Gold is the safe haven. Gold is the monetary metal. And they've been right about gold, but they've been completely wrong about what happens next. Because while gold has been making headlines and breaking records, silver has been quietly positioning itself for something that hasn't happened in over 40 years. A true supply crisis, not a temporary shortage. A structural deficit so severe that the global economy cannot function without it, and the world cannot produce enough of it. Let me show you exactly why 2025 through 2027 will be silver's breakout cycle. Not gold, silver. Most people think gold and silver move together, but that's not how it works. History shows a very specific pattern. Gold leads, silver follows, then silver outperforms dramatically. In the 1970s, gold broke out first in 1976, rising from $100 to $200. Silver lagged. Then in 1979 and 1980, silver exploded from $6 to $50. That's a 733% gain, while gold went from $300 to $850, a 183% gain. Silver outperformed gold by 4 to 1. The pattern repeated in the 2000s. Gold broke out in 2001, rising from $300 to $900 by 2008. Silver lagged. Then, from 2008 to 2011, silver detonated from $9 to $49. A 444% gain, while gold went from $800 to $1,900, a 137% gain. Silver outperformed gold by more than 3 to 1. Right now, in 2025, the exact same pattern is setting up. Gold has been leading since 2019, breaking from $1,200 to over $4,000. Silver lagged initially, stuck below $20 until 2024, but in 2024 and 2025, silver began its move from $20 to $50. The explosive phase hasn't happened yet. Every time silver breaks above $30 and holds, the next move takes it to $60, $70, $80 or higher. We're at $50 right now. The pattern says silver has 50 to 100% more upside through 2027. The gold to silver ratio measures how many ounces of silver it takes to buy 1 ounce of gold. Throughout most of history, this ratio averaged between 15 to 1 and 30 to 1. In modern times, it's become far more volatile. Right now, the ratio sits around 80 to 1. Gold is trading near $4,000, silver around $50. That's well above the historical average of 60 to 70 to 1. The ratio peaked at 125 to 1 in March 2020 during COVID. Then from March to August 2020, silver exploded from $12 to $29, while gold only went from $1,700 to $2,050. The ratio collapsed from 125 to 70 to 1 in 5 months. If the ratio returns to 60 to 1 and gold stays at $4,000, silver goes to $66. That's a 32% gain. If the ratio compresses to 50 to 1, silver goes to $80, a 60% gain. If it hits 35 to 1, like in 2011, silver would trade at $114. More than doubling from here, gold has already had its breakout. The ratio is stretched. Silver is the compressed spring waiting to release. But the ratio is just the technical setup. The real story is the supply crisis. Silver faces a structural supply deficit. In 2021, global silver demand exceeded supply by 51 million ounces. In 2022, deficit of 237 million ounces. In 2023, 184 million ounces. In 2024, 215 million ounces. In 2025, projected deficit of 117 million ounces. Added up. Over 5 years, the cumulative deficit is approaching 800 million ounces. That's nearly 1 full year of global mine production, drawn down from inventories. And those inventories are now at multi-year lows. Global mine production is roughly 835 million ounces per year. Recycling adds another 150 to 200 million ounces. Total supply is around 1 billion ounces annually. But demand in 2024 hit 1.2 billion ounces. The gap is 200 million ounces per year. And it's not closing. Why can't supply catch up? Because 70% of silver production is a byproduct of other mining operations. Silver comes from copper mines, lead mines, zinc mines, and gold mines. Silver is extracted as a secondary product. This creates a fundamental problem. When silver prices rise, it doesn't automatically incentivize more silver production. The economics of those mines are driven by copper, lead, zinc, or gold, not silver. If copper prices are low, the mine doesn't increase production just because silver is expensive. Silver supply is inelastic. It cannot quickly respond to demand. And right now, base metal prices have been weak. So silver production remains constrained. Primary silver mines only account for 30% of global supply. And new mine development takes 7 to 15 years from discovery to production, permitting, financing, construction. The timeline is a decade or more. Declining ore grades make the problem worse. Miners must process more rock to extract the same amount of silver. Exploration for new deposits has been chronically underfunded for decades. The pipeline of future supply is nearly empty. The supply side is locked. Supply cannot surge to meet demand. This is the setup for a true shortage. Now let's talk about demand. While supply is constrained, demand is exploding from sectors that didn't exist 20 years ago. Solar panels are now the single largest industrial consumer of silver. In 2015, solar consumed 60 million ounces per year. In 2024, solar consumed 232 million ounces. That's a 287% increase in less than 10 years. Silver is essential to solar photovoltaic cells. Silver paste captures and transports electrons. Silver's electrical conductivity is unmatched. Each solar panel contains 15 to 25 grams of silver. Global solar installations are projected to exceed 500 gigawatts per year by 2027. China alone plans to add 160 gigawatts in 2025. Solar demand could reach 250 to 300 million ounces annually by 2027. That's 25 to 30% of total global production going into solar panels alone. Some argue substitution will reduce silver usage. The industry has reduced silver loading per watt from 130 milligrams in 2014 to 80 to 100 milligrams today. But the scale of deployment overwhelms the efficiency gains. Even if silver per panel drops 20%, total installations are growing 400%. The net result is still massive demand growth. Electric vehicles use 2 to 3 times more silver than traditional cars. A battery electric vehicle contains 25 to 50 grams versus 15 to 28 grams in traditional cars. Global EV production was 14 million vehicles in 2023. By 2030, projections suggest 30 to 40 million EVs per year. That's 35 to 40 million ounces of silver demand from EVs by 2030, up from roughly 15 million ounces in 2023. Electronics, 5G infrastructure, semiconductors, and AI data centers all require silver. Silver is in virtually every electronic device. The expansion of 5G networks globally requires massive amounts of silver. Data centers powering AI use silver in servers and cooling systems. Medical applications are growing. Silver has natural antimicrobial properties used in wound dressings, surgical instruments, and hospital surfaces. Total industrial demand hit a record 680 million ounces in 2024 and is projected to exceed 700 million ounces in 2025. Industrial demand alone is now more than 70% of total silver demand. This is structural, not cyclical. These technologies are not going away. This demand is locked in for the next decade, and supply cannot keep pace. Investment demand is the accelerant. Silver-backed exchange traded products recorded net inflows of 95 million ounces in the first half of 2025 alone. By June, global silver ETP holdings reached 1.13 billion ounces. The total value hit all-time highs exceeding $40 billion. In 2020, during the brief silver squeeze, ETFs added hundreds of millions of ounces in months. Retail investors flooded in. Premiums spiked 50 to 100% above spot prices. Dealers ran out of inventory. If the investment community recognizes the 800 million ounce cumulative deficit, capital will pour into silver. And unlike gold, the silver market is much smaller. Total annual silver supply is worth roughly $50 billion at current prices. Gold supply is worth roughly $700 billion. Silver's market is 14 times smaller than gold's. The same amount of investment capital has 14 times more price impact in silver. Goldman Sachs began recommending long silver positions in April 2025. UBS upgraded forecasts to $55 by mid-2026. Bank of America projects $65. Central banks are getting involved. Russia and India have added physical silver to reserves. Saudi Arabia purchased the SLV silver ETF. When central banks start accumulating silver, it signals a regime shift. Silver is no longer just industrial. It's strategic. There's another factor most people don't understand: the paper silver market. Daily trading volume on COMEX regularly exceeds 150,000 contracts. That's 750 million ounces traded daily on paper. The entire global mine production for a year can trade in just a few sessions. COMEX warehouse stocks typically range between 280 to 320 million ounces, but that inventory supports trading volumes many times larger. Less than 1 to 3% of futures contracts result in actual physical delivery. JPMorgan Chase paid $920 million in September 2020 to resolve criminal charges related to manipulating precious metals markets. Deutsche Bank settled a silver price fixing lawsuit in 2016 for $75 million. As investment demand removes physical metal through ETPs, the available supply backing the paper market shrinks. When ETPs hold more silver than London vaults, physical tightness becomes real. In November 2025, as silver futures approached $54, the Chicago Mercantile Exchange experienced a cooling system failure. Trading halted for over 10 hours. Silver had gained 84% year over year. Whether coincidence or coordination, it revealed the fragility of the paper market. The timeline for Breakout is 2025 through 2027. The cumulative deficit is approaching 800 million ounces over 5 years. In 2026, the deficit continues. Estimates range from 140 to 200 million ounces. By 2027, the cumulative deficit could exceed 1 billion ounces. At some point, the market breaks. Physical shortages become acute, prices adjust violently, but new supply takes a decade to develop. The only adjustment mechanism is price. Historical precedent suggests that happens when silver reaches $70 to $100 per ounce. At those prices, recycling becomes highly profitable. Electronic scrap recovery scales up. Every available ounce gets recovered. At $50, recycling is growing but not surging. The market needs $70 to $100 to unlock maximum recycling supply. The price trajectory from here is up. Silver broke above $30 in 2024 and held. That was resistance for over a decade. The next major resistance is $50. A monthly close above $50 confirms the breakout. The next targets are $60, $70, and $80. Bull markets in silver last 2 to 3 years once they begin. The 1979 to 1980 spike lasted 18 months. The 2009 to 2011 run lasted 28 months. We're roughly 12 months into the current move. That suggests another 12 to 18 months of upside through 2026 and into 2027. Who wins? Physical silver holders. Silver mining companies with operating leverage could see 500 to 1,000% gains if silver reaches $80. Royalty and streaming companies win. They get exposure to higher prices without operational costs. Who loses? Industrial consumers face rising input costs. Solar manufacturers see margin compression. Governments lose strategic flexibility. Short sellers get destroyed. Gold holders underperform on a relative basis. The key insight is this. Gold and silver are both monetary hedges, but silver has an additional demand driver that gold lacks: industrial necessity. Gold is primarily investment and jewelry. Silver is 60 to 70% industrial. Silver is consumed. It's used up in products that never get recovered. This dual nature creates a perfect storm. Investment demand provides momentum. Industrial demand provides the floor. Supply constraints provide the squeeze. Let me be clear, this is not financial advice. This is pattern recognition and data analysis. Silver is volatile. It can fall 30% in weeks during corrections. The timeline is 2025 through 2027. During that time, there will be pullbacks and corrections. The path is not linear. There are risks. A global recession could temporarily destroy industrial demand. Technological substitution could accelerate. Government intervention could distort markets. But these risks exist for every commodity. The question is whether the risk reward is favorable. Based on the data, the supply deficit, the demand growth, and the technical setup, silver between $40 and $50 offers compelling risk reward for the next 18 to 24 months. For those positioning, the strategy is accumulation during pullbacks, not chasing breakouts. Use weakness below $45 to build positions. Scale in over time. Maintain realistic expectations. Doubling from $50 to $100 is possible. But it takes time. This is the setup. Gold led from 2019 to 2024. But the historical pattern says silver's turn is now. The supply deficit says silver has no choice but to rise. The gold to silver ratio says silver is undervalued by 30 to 50% minimum. Industrial demand says this is structural. Investment flows say recognition is building. 2025 through 2027 is silver's window. 800 million ounces of cumulative deficit cannot be ignored. Industrial demand of 700 million ounces cannot be shut off. Supply constrained at 1 billion ounces cannot surge. The market will adjust, and the adjustment mechanism is price. That process is already underway. The breakout has begun. The question isn't whether silver outperforms. The question is whether you position before the majority realizes what's happening. This is the pattern. Gold leads, silver follows, silver outperforms. It happened in the 1970s, it happened in the 2000s. It's happening right now. The setup is complete. The deficit is real. The timeline is 2025 to 2027. This is silver's cycle.